Hi guys, I'm Andrew, and my final paper is on the NRSROs and the housing crisis. Um, so the table of contents will be divided into three parts. First, I'll explain what an NRSRO is, and then explain the most important aspects of the housing crisis, and finish up with the relationship between the two. So an NRSRO stands for Nationally Recognized Statistical Rating Organization. It's also known as just a credit rating agency. And an NRSRO's job is to fairly and objectively assess the credit rating of a bond. Um, so a credit rating is something that designates the credit risk of a security, and it's tied to the likelihood of default. So basically, the higher the rating, the less likely that the firm will default. And credit ratings are really important for the financial sector and for the economy in general. For borrowers, credit ratings are a determinant in the cost of debt, which can make a difference of millions of dollars in interest payments in the long run. And for lenders, investors rely on credit ratings because they don't really like a lot of individual investors don't really know how to carry out a credit analysis. And so they have to rely on NRSROs to look at the credit rating. And institutional investors are actually required by law to invest only in bonds that have high credit ratings. So you can see that NRSROs are really important for capital markets, and this should mean that they give out ratings on based on due diligence. So now that we have a basic understanding of NRSROs, we should move on to the housing crisis. The dot-com bubble burst in 2001, and it led to a mild recession. And so, to combat the recession, the Fed actually cut interest rates to near zero, which is what they usually do, and it's what they did right now as well. And at around the same time, the Bush administration also started government programs that encouraged home ownership. And so, as a result, subprime mortgages increased really rapidly, and buying a house became really easy. Which meant that due to the really high demand, the price of houses increased to unsustainable levels, which is what a bubble is. And so a subprime mortgage. So what is that? It's a loan granted to individuals who have really terrible credit scores. Basically, the banks were giving out free money to anyone who applied for a mortgage. The question is why, but it was because of two reasons. The first is that defaults didn't matter. So the banks believed that due to the housing bubble, the banks believed that the house prices would just keep increasing. So if a subprime borrower defaulted on his mortgage, then the bank could simply seize his house and sell it in the market for a profit. Um, and the second reason is that the demand for home loans by investment banks were really high because they were using these loans to create securities called CDOs, which I'm going to talk about next. Mortgage banks were pressured to keep producing mortgages, and so the standards for a home loan became a lot less strict. So that's why subprime mortgages increased so rapidly. I'm going to try and explain what a CDO is. So it's a structured financial product made by investment banks. The investment bank basically buys a huge amount of residential mortgage loans from commercial banks and then packages them together into securities called a CDO, and then it slices these securities up into different tranches, right? So the CDO buyer has the right to receive the mortgage interest payments instead of the mortgage originating bank. And the CDOs are divided into sections called tranches, based on the credit ratings that we talked about earlier. So the senior tranche is rated the highest, followed by the mezzanine tranche, and the riskiest tranche is called the equity tranche. And they're the least popular because they're the riskiest. And so the demand for equity tranches will be the lowest So what the banks did is that they collected all the unsold equity tranches and repackaged them into a new CDO. This was called a CDO squared, and we know that CDO squareds are only made up of equity tranches, but somehow they were also split into these three senior mezzanine and equity tranches as we saw with the first CDO. And this was really weird. Uh, but basically, the underlying logic was that the diversification benefits of these millions and millions of equity tranches would make some safe and some not safe, just because of pure probability. So that's how they made a CDO squared and then sold billions of dollars worth of it. And this process with these unsold equity tranches from the CDO squareds was continuously repeated to make CDO cubed and so on and so on. And the NRSROs were the ones who were rating these CDOs. So why was that a problem? That was a problem because of the business model. So NRSROs use an issuer pays business model, which means that the people who are trying to get a rating on their product are the ones who are paying to get the product. So, due to this business model, we can predict a huge conflict of interest, which is when there is a clash between personal interests and professional duties. And so basically, the issuer has incentives to receive the highest possible rating because, as we saw before, a high rating means that it's going to sell for more expensive because it means it's safer. And NRSROs also have incentives to give out higher ratings because this will attract more clients who want higher ratings. Um, so it was kind of like a vicious cycle, right? And this basically just kept on happening until the housing bubble popped, and then all the CDOs became worthless, and that kickstarted the Great Recession. So the we can see that the credit ratings were just way too liberal. Um, as we saw a couple slides ago, the CDO squared was consisted solely of junk equity tranches. Um, but somehow sections of these CDO squareds had triple A ratings, which makes no sense. And by summer 2008, Moody's downgraded like 80% of the 90% of the CDOs that it had rated. So that's kind of crazy if you think about it. It means they're admitting that they were wrong about 9 out of 10 ratings, which is just, it doesn't make any sense. Um, so the economy just completely tanked, as we can see from 2008 to 2009. Millions of people lost their homes and jobs, and um, not just in the US, but also just all over the world because the financial sector was so internationally linked that banks in like France and Germany and like Asia were all just going crazy over the housing bubble crash. And the financial sector especially just blew up, sort of. The Lehman Brothers basically just blew up. Bear Stearns was sold to JP Morgan. Merrill Lynch was sold to BOA. And Washington Mutual, it was the largest savings and loan association in the US, also collapsed. And Wachovia, which was a bank holding company, also collapsed. And AIG, as we all know, it's one of the biggest insurance companies. It had to be bailed out by the US government at an amount of $150 billion. Uh, and just investors lost around $7 trillion. Um, so as we can see, this very simple and very foreseeable conflict of interest had a really big effect on the economy and the financial sector. So I feel like this issue should be something that is talked about more often, which unfortunately is not. So that's why I sort of wanted to do my essay and my presentation on this topic, just to explore sort of the issuer pays business model and how it just contributed to the 2008 recession, and you know, like why there hasn't been much change about it. So yeah, so that's the end of my presentation. Thank you.